Good morning and welcome to your Financial Empower Hour. I'm Jason Cryderman with Great Lakes Investment Advisors. Thank you for joining us on a beautiful Sunday. Tony Shore, my co-host, is with me today over from Minneapolis, Minnesota. And we also have another special guest with us today, Tony. We have the very fortunate blessing to have Tyler Ellegard from Gradient Investments, a portfolio manager, with us again today. So awesome. Tony, Tyler, how the heck are you guys doing today?
Tyler, you go first. You've been busy, haven't you?
So I've been busy, but we were talking before we started that the Lions had a fantastic weekend, and so did my fantasy team because I have St. Brown and Montgomery on my team.
Oh, so that helps.
Tyler,
I was feeling pretty good. I
knew you were a smart man because Tyler's job, by the way, listeners and viewers, he's a portfolio manager for Gradient Investments, and Gradient Investments is a third-party fiduciary wealth manager. They analyze stocks, bonds, mutual funds. They analyze sectors of the markets. They analyze trends, and then they pick what they believe would be the best holdings to own in certain portfolios at certain times. Very similar to Tyler, I knew you were an awesome portfolio manager. I knew you were an awesome analyzer, you do a phenomenal, just an absolute touchdown, home run, grand slam when you manage portfolios. That's a known, right? But what you just said on your fantasy football team tells me that you take your professional life of being such an awesome analyst and picker, you take that to your personal life. That's because right. You just picked two. You must do a lot of analysis, and you just picked two of the absolute best players of the National Football League you could have on your fantasy football team, and they brought you probably to an awesome winning weekend, didn't they, Tyler?
They sure did. But we'll go with that fantastic
now, who were those picks again? I might have missed that. Who did you pick? Who did you analyze and pick again for your team, Tyler?
St. Brown and Montgomery.
Oh, and they play for who, Tyler?
Detroit Lions. It's always a hard thing when we're doing fantasy sports because you don't want to be drafting someone when you're a Vikings fan who could potentially beat you. But
right.
At the end of the day, if you want to win fantasy, you got to separate the two emotions. So,
well, that's it. And I mean, think about what you just said, separate the emotions. No different from what you do when you're managing portfolios and what I help do, my families that I help build and manage their portfolios, or with your assistance, we do that, is we got to separate the emotions, right? I mean, absolutely. At the end of the day, and I've been guilty. I'm a diehard Michigan State fan. I went to Michigan State. That's where I met my beautiful wife, Amy. However, I'm no dummy. And when it comes to my money, if I have to at some point in time put some money on the line and bet against Michigan State, I love Michigan State, but I love money too. And so it's like,
well, you better clip this. You better hold on to this clip.
So we're kind of diving in a little bit to our personal lives, I guess, and we're really opening up and exposing ourselves here, which I think is awesome, though. Our listeners and our viewers, that's what they deserve, though, right? I mean, we just talked. I've been doing this radio show for over 5 years now. I've had 3 different companies or 3 different co-hosts with me. Tony just mentioned to me this morning, for my listeners and my viewers, Tony just mentioned to me this morning that, Tony, you said this is our 100th show that you and I have recorded together?
Yes, it is.
That's awesome.
And to celebrate, we wanted to make it an extra special show, which is why we got Tyler Ellegard, one of the premier portfolio managers, to be a guest on our show today, on our 100th show. And time flies when you're having fun, doesn't it, Jason?
Man, it sure does. I mean, it's hard to believe. I mean, for, again, our listeners and viewers. So we record these shows usually on a Monday, then they go through editing. They would air the following Sunday. We do miss a few Mondays throughout the year. Obviously, there's holidays, there's vacations, there's personal and sick time for myself or for Tony. So we don't record every single Monday. But to think about that, Tony, you and I have already recorded 100 shows together. Yeah. I mean, time flies. That's amazing. And you've probably been the longest running host I've had on my show. And I believe I've been recording shows for almost 5 years now on radio, because, the connection we have, you and me, and with our team at Gradient, that kind of pulls us together and provides us our awesome content as well as our awesome guests like we have today. And I couldn't have had a better celebration for my show than to have one of Gradient Portfolio's #1 portfolio managers, Tyler, on the show today, Tyler. So thanks again, man, for celebrating in this awesome 100th show recording with Tony and I. Thanks for thanks again for those fantasy football picks. I mean,
Yeah, well, I mean,
Absolutely.
he takes the emotion out of investing. He takes the emotion out of sports picks, and really makes some great picks there. So this is a guy you can trust. I like that.
well, he's just, I think, Tony, what you just said is he's just non-emotional. The guy's got no emotions. And obviously that's not true, but that's not true. But, you know, at the end of the day, we're going to talk a lot today. We're going to talk a lot today about obviously the market. Here we are just a week or two or a couple weeks after the presidential election of 2024. So today's show, we're going to focus a lot on the now what. I mean, what is the last maybe 4 years or year or 6 months or 3 months looked like? What have we went through in our lives from a personal standpoint, a obviously political cycle standpoint, a portfolio or stock market standpoint, and then what does the next maybe 6 months or 4 years look like? And taking our emotion out of this, you know, Tony, you and I talk about this all the time on the show, and Tyler and I, when we meet, when we meet for our trainings, when we do our monthly and quarterly trainings with him and his team, we are always talking nonstop about how important it is to take our personal emotions out of our portfolios. For the last 6 months or year, we've talked a lot about take your political thoughts and feelings out of your portfolio. And Tyler, I know, is going to talk a lot today about how that was, the pros and cons, allowing things like that to happen. And emotions is hard to control, but with Tyler's professionalism and his background of being a portfolio manager, he does a phenomenal job at helping not only do that for his team at Gradient when they do all of their analysis and picking what stocks or bonds or mutual funds, which holdings they're going to have in their portfolios. But Tyler and his team also do a phenomenal job with the advisors, like with myself. And how do we coach our families and our investors to allow the team behind us, allow Gradient to do what they do while we take our emotions off the table, and through the thick and thin, through all the good and the bad. Hands down, that is the best way to manage a portfolio, whether you're a do-it-yourselfer, you have another team helping you, or you're with myself and my team at Gradient Investments, allowing them to do that from a professional standpoint and taking our emotions off the table. Tyler, it's been awesome. You've helped train me that. You've helped train my team that. So thank you for that.
Yeah, thank you. Appreciate everything that you do with us as well. So it's mutual.
Well, thank you. Appreciate that.
So, yeah, I mean, I think obviously there's been a lot that has happened over the last, call it 6 months, maybe. Right?
It's been crazy. I mean, it's, I don't know if you guys, I'm sure you guys feel the same as I do. And I know a lot of our listeners and a lot of the clients I've sat down with for the last 2 weeks have just said, we are so relieved that it's over. We are just so relieved. The last 3 to 6 months has been, I mean, our mailboxes are full. How much money does it cost every day to get 25 to 50 of those postcards in your mailbox? I mean, they spend, I can't believe the ungodly amount of money that was spent on radio, on TV, on Facebook, on how do they get our personal cell phone numbers and all the texts and phone calls we were getting, and then our mailboxes. We're all just very relieved that it's over. Like you said, Tyler, man, what we've been through has been crazy. And so I love how you and your team are going to break it down into very simple to understand basics about, that was craziness in our world personally, but let's focus on financially. What was all that political stuff flying around, the political tornadoes we just went through for the last 3 to 6 to 12 months? What has that done to the market? When we talk about like stocks and bonds, and what has that done to interest rates and the feds, and what is it doing to certain sectors or companies, and what does the future look like? So I'm very, very excited, not only about today's show, but to hear what you and your team, Tyler, have to say over the next 3 to 6 to 12 months, because it's obviously a huge transition. It's a big shift. Some of it anticipated, some of it probably feared, but really at the end of the day, what are you and your team thinking right now after just coming off that election? What's going on behind the scenes at Gradient Investments?
Yeah, well, I think if we take a step back and look at, just after the election, the market performed extremely well when we, found out that Trump was the president-elect. And when we think back to it, we always think back to what is the market like? The market likes certainty, right?
Yes.
And for, I would say a majority of the race, once Kamala Harris started getting into it, the polls were showing both of them pretty neck and neck, I would say, for the majority of that time period. Now there were some splits here and there, but at the end of the day, on election day, the polls, I checked Wall Street Journal, New York Times, and they had 50-50 was the direction, right?
Isn't that crazy? Yeah.
That's pretty uncertain and if you think about what the market likes in that certainty, it's the most uncertain that you can possibly get. And so post-election, we saw the market have a pretty significant rally. Now you could chalk it up to different policies that President-elect Trump might have. But I think at the end of the day, a lot of that was the election was so decisive, right? It wasn't this wishy-washy, we have to recount a couple of states and we're going to drag this out for weeks on end.
Like we had from the last election.
Yeah. Lawsuits and just dragging it on, uncertain.
Yeah. And so I think the fact that it was so decisive from the US, it allowed the stock market to breathe again because it wasn't breathing for, I would say, a couple of weeks leading up to the election. So, yeah, you could say that Trump has some policies that could benefit the market, but, Harris could have had some policies that could have benefited the market as well. So either way, I think just the decisiveness of the win for Trump was the reason that we saw the big rally post-election. So I think and then we can start diving into, what policies are going to do this or that. But just to give you an example, so you talked about last election, but I think the best example of showing what uncertainty looks like is go back to the 2000 election where, there was lawsuits and it dragged out into the new year. If you looked at the market performance during that time, it was down about 12%. And that's exactly what the market doesn't want, right? It doesn't want that uncertainty. So if you ever want to look at a case study of what the market does and doesn't like, just look back to 2000 election versus looking at maybe even 2016 or looking at this election where you get the decisive victory to show that, the market doesn't have to worry about it anymore. So those are my initial thoughts on the election. And I'm by no means a political expert. My one concern that we have right now is Trump made 13 cabinet selections so far as we're recording this. 13 in 13 days is what he's done. But the question is becoming how many of those 13 can get past Congress? And so if we don't have leaders in the positions, that could create some angst for the market as well going forward. If you don't have a Treasury Secretary or you don't have the head of the DOJ or, there's certain things that need to be put in place upon arrival. And if we don't have cabinet positions filled, I think that could be one concern. So there's still some headwinds or uncertainty for the market.
Sure. Yeah, absolutely.
But it's still not as big as, who's going to be president, right? Yeah. So I think the market, generally speaking, is now done with the election. It knows what's going to who's in, and we can focus on other things going forward. So that's the initial take there. But then if we start to look at what are the policies, we had the Senate. So I'll also talk about the Senate. So Senate is obviously Republican and the House is also Republican. So I think the initial thought too was that because the House took over, I think it's 53 seats, maybe 52. Either way, Republicans have control. But Trump's pick for Speaker of the Senate was not who was nominated, right? We had somebody else. So it might keep Trump's policies in check a little bit, which I think is good, right?
Yeah, it's not a bad thing. Absolutely not. No, that's not a bad thing at all. That's why we generally,
So despite the full red wave, it might not be the full Trump wave, I would call it. So if we think about some of the policies, though, I think the two big ones are 15% corporate tax rate. I think that's a pretty big one for investing.
Absolutely.
And then when we think about tariffs, that's going to be a big one as well. And the tariffs are basically 20% global tariffs on any imports, and then 60% on Chinese goods. So when you think about whether it's small businesses, whether it's large businesses, every business gets product from outside of the US, right? We just don't do all of the manufacturing here because it's expensive, right? It's plain as simple as that.
globalization, right? I mean, globalization think about the years and way back, we're talking 20, 30 years, 40 years of globalization. We become such a globalized economy that, yeah, there's nothing anymore. I don't think that's truly,
Yeah.
it's designed, produced, made 100% in any one area. And so I think that's awesome. I love that you touched on like the House, the Senate, it's not really a Trump thing. It's a president, and it's the policies. And so let's get ready as we flow into the next segments here. We're going to break down and go a little deeper into some of that stuff you talked about right there, and what it means maybe today for investors in the market, the economy, and what like maybe the next 2 to 4 years might look like based on the results of the election we have today.
Absolutely. Yeah. So if we start to think about those two big things, taxes and tariffs, TNT. Well, let's start off with taxes. So cutting taxes down to 15% would obviously be a big boost to companies and their profit that they generate.
Absolutely. Yeah.
So that's going to be a tailwind for investors, and that starts as soon as they can pass that. So I think what the market is trying to do is figure out what is the actual certainty of that happening. And I think and the reason I brought up the Senate is because there may be less certainty than there was before, now that it's not a Trump speaker in the Senate, right? It's kind of you could call it a Republican opposition, if you will. So it might be a little bit more challenging to get the exact thing that Trump wants passed. But regardless, I think, you put a 15% tax on corporations, it allows them to spend money in a lot of different areas, whether it's back on the business or return to shareholders, whether it's dividends or stock buybacks. So there's a lot of different ways that the 15% corporate tax rate will help, which would be a boost to the stock market in general. And that's, as long as that policy would be in place, that's what we would get. Now, the flip side of that, and where the market, I think, we saw the initial bounce post-election, where I had said that's probably due to the big votes that were given towards Trump, and now the certainty of who's in office. But now I think what the market is trying to figure out is you've got the pros of the tax cuts, but now he's also introducing the tariffs, which, if we think of what tariffs do, it just means higher costs to the companies producing it, right? Because we have to import the goods into the U.S. and then try and sell them. So there's a markup of 20% or 60%, depending on where it's coming from. So what does that mean for companies? Well, we're all familiar with what happened in 2022 with 9% inflation, right? Companies were passing through every price increase they possibly could.
Absolutely.
Prices hit the consumer. Now we're starting to see a consumer that is, and there's a bifurcation in the consumer too. High-end earners are fine, lower-end earners are not great. And so we're seeing consumers that are being stretched in their wallet, right? They just can't afford as much as they could before. And so you ask the question, well, who's going to take the price hit on these tariffs? Is it going to be the consumer, or is it going to be the company? The company certainly doesn't want to do it, but the company probably can't pass through all of the increase in cost from the tariffs. So there's probably going to be a healthy balance there where the company eats some of it, but then they inevitably have to pass on some of that cost to consumers, and hence we start to see inflation pressures again. Right. So, and that snowballs into a lot of different things. What does the Federal Reserve do? Do they keep interest rates high? All sorts of different market impacts that tariffs can have. So I think that's really what the market is grappling with today, and why we saw initial jump post-election, and now we've kind of trailed off a little bit, or kind of flatlining, if you will, because the market's trying to assess, as Trump is putting these cabinetary positions in, how is all of this going to play out? Is he going to be able to get everything done that he wants, and specifically what he wants, or are there going to be some deal making and handshaking to just get something passed? And so from the perspective of how do we think about this today, that's what the market's doing right now, is trying to figure out what policy is going to actually get through, are both going to get through, and how will that actually impact companies.
Good. Yeah, good.
Well, wouldn't you say, Tyler, also, not to take it away, I know you're talking about the political aspect, but the bump in the markets, I was thinking about that the day after the election, the market skyrocketed, and I agree. I think the main reason is, I like your comment, how the main reason is probably the certainty at which it happened. There's no uncertainty, and the market likes when things are certain and set. It hates uncertainty. But the same day, the Fed lowered the interest rates, right? Didn't that happen? That really helped too. That didn't hurt it, right?
Yes, that did not hurt. So yeah, we can transition to that really quick. So yeah, the Federal Reserve has officially lowered interest rates again. Now, the first one that they lowered was 0.5%, whereas this one was 0.25%. So not as big in magnitude, but it just means that the Federal Reserve is cutting interest rates, and maybe it makes things a little bit more affordable. So yeah, that's a great point, Tony. That certainly helps. When you think of what is the actual borrowing cost for companies, if interest rates are going down, that would generally mean that borrowing costs for companies is going down as well. So generally speaking, I think that was an additional boost to the stock market's performance that day too.
Okay. Yeah, I was just curious on that. That's interesting. And I mean, I know, Jason, you work with, when you talk to your clients, inflation and the interest rates have been a big topic, obviously,
absolutely.
the last few years. So
the last 2-3 years. Yeah. I mean, Tyler mentioned like 2022. I mean, it all started back in 2020 when COVID hit, and things, the stock market and interest rates and inflation, price of goods, everything's changed. And I don't think anything's come back to what we would call pre-COVID normalization. And I don't think we'll ever see that again. I think now we're into a new normalized period, but things are always changing. And I think off the heels of this election, things will continue to change moving forward.
Yeah, I always like to throw out this reminder for inflation, because I think, we do get that question quite a bit, where it's like, well, are we ever going to see the prices again? And we always have to say, well, no, because, the cost for a loaf of bread, pre-COVID was $1, and then it jumped to say $1.50. And so what inflation is telling us is going from 150 to 170 is what inflation is doing, rather than going from 150 to $2, right?
Yep, you're still seeing
increases,
costs increase, but not at the same rate.
Yes, exactly.
Yeah. And moving forward, what about the Fed? What are your thoughts on that, Tyler? Because now we're getting indication. I read today, some of the markets were down initially. Now I see they're back up. You can't, they go up and down all the time. But I heard that the Fed, Powell indicated that maybe they'd hold off on further lowering.
Yeah. So the question was whether they would actually do another interest rate cut in December. So they have another meeting coming up in December.
Right.
Initially heading into the November meeting, the Fed was expected to cut 0.25% in November and 0.25% in December as well. But after Jerome Powell's commentary saying, the economy's still doing fantastic, right? We're not seeing anything that would mean that we need to cut interest rates extremely rapidly. So maybe we might remain data dependent and pause this go around, and then consider doing another interest rate cut again in January of next year. Because look, the Federal Reserve has a target inflation rate of 2%, and they have a mandate as well to keep unemployment as low as possible, right? Or I shouldn't say as low as possible. I should say unemployment at a healthy pace. They don't want to see unemployment at 8%, but the average over the last 20 years is 5 to 5.5% unemployment. So we're sitting at 4.1% right now. So I'd say their job on that is pretty darn good. So they have to focus really on inflation still. And us being above that 2% target, maybe they don't need to cut interest rates as much as they thought they did a couple of months ago. So yes, the question is there, do they cut or not? I think at the end of the day, what I really pay attention to is where are they projected to be by the end of next year? Because they can switch it around. Maybe they pause in December and then cut in January. And then even though they might have expected to not do anything in January, right? So like just flopping the months around, at the end of the day, it doesn't really do anything. 1 month lag in 0.25% is not going to really matter. So what I always pay attention to is where are they projected to be the next year, by the end of the next year. So now I'm thinking, where are they going to be by the end of 2025, right? And so what that tells me is, where are the rest of interest rates going to be, whether it's a 2-year treasury, a 5-year treasury, or a 10-year treasury. That's really why I pay attention to that, is because that's going to help guide me on where I position bond portfolios, to say, should I have more, should I own more 10-year treasury bonds?
Sure. Mm-hmm.
So I don't know that we want to go deep into my nerdiness of interest rates. I don't want to bore your listeners to death, but yeah. So, the Federal Reserve, again, at the end of the day, I pay attention to where are they going to be at the end of 2025, not necessarily what are they exactly going to do next meeting.
Sure. Makes sense. Yeah.
Yeah, I think that's huge. Hey, we should probably take a quick break here. But before we do, Jason, let our listeners out there know how they can get a hold of you.
Yeah, really quick, easy ways. First of all, just give us a call here at the office. The number is 989-835-7203. That's 989-835-7203. Can always stop by. We're right here at 135 North Saginaw Road in Midland, or you can visit us on the website at GreatLakesInvestmentAdvisors.com.
All right. Well, this has been a great discussion so far. We're listening to your Financial Empower Hour with our special guest, Tyler Ellegard, and our host, of course, Jason Cryderman. Tyler, you've had a lot of great information for us so far today. Jason, what else should we ask Tyler today? Tyler, what else do you have for us?
Well, I know Tyler's full of, I didn't say Tyler's full of it. The little listeners, if you thought that I was going to say it, it just popped into my mind. I almost did, but Tyler's obviously full of some phenomenal wealth of knowledge.
There you
Tyler,
go.
who did you pick on your fantasy team? You told us at the beginning of the show. Who were your 2 best picks on the fantasy team this week?
I want to admit it again, Jason. But
okay, so if you heard the first segment of the show or watched it, you know that Tyler picked 2 of our Detroit Lions, and that's awesome. Well, I got to admit though, my son Carson, he does fantasy football as well, and he has had some Minnesota Vikings on his team so far this year over the weeks, and they've done him very well. So I like that we can share with each other there. Yeah, so that's a good thing. But no, this has been a great show, Tyler. We started out talking about the stock market, and Tyler started out in the first segment talking about how the stock market for maybe the last 3 months or so couldn't really breathe. It was kind of constrained, and what that really meant was, again, the stock market, the S&P 500, for most all intents and purposes here in the U.S., the major index, the stock market likes certainty. It really doesn't care whether it's male, female, black, white, Republican, Democrat. We have statistics upon statistics upon statistics and charts, and you name it, that prove that the market doesn't. What the market thrives on in these businesses, these corporations, is certainty, that they at least know what the policies are going to look like for the most part for the next 4 to 6 to 8 years. And so I think that's what you meant, Tyler, when you said the market finally, the day after the election, it was able to breathe. Mm-hmm. Weren't we all? It was over, right? The election was over.
Yeah, not just
whether it was your team or not. And so I want people it wasn't a Trump rally, I don't necessarily think. I mean, maybe there could have been, but no, I think it was a sigh of relief and now a certainty rally. That's really what it was. The Trump rally, really, we may have seen some of it, but that might not come in, like you said, Tyler, until we really see come January. And after that, what all do they get passed, and how does it positively impact our market and our economy and our interest rates? So I think that was really cool. I want to go into a little bit more of that on this second segment. We left the last segment talking about the Federal Reserve. We could do a whole show just on Federal Reserve and interest rates.
The Fed.
Yeah, let's move forward, I guess, on now moving into I want to end the show. I want to end the show by what could happen between now and January, good or bad. Okay. But before we go there, let's kind of go more into what we think might come out of now the Trump administration moving into office in January in different sectors or certain aspects of the market.
Yeah, so what I'll say is we're always cautious about making those calls before we actually see policies put in place. And the reason I say that is a great example of this is Trump's campaign and presidential time in office from 2016 to 2020. He had a pretty similar slogan of drill, baby, drill, right? And so a lot of people thought, a lot of investors thought that energy stocks would be fantastic. But lo and behold, it was the worst performing sector during that time for the S&P 500.
Yeah.
So I think right now, and we're hearing a similar story, drill, baby, drill. It's going to be great for energy service stocks. But at the end of the day, oil's a commodity. You have a pretty consistent level of demand, and all of a sudden, if you start drilling, you open up regulations for federal lands, more oil's coming out, more supply does not equal higher prices.
Sure.
So, what we've been saying here in-house has been there's perception versus reality. And right now, investors are positioning for the perception. We have to see the reality first of what is actually put in place before we make any knee-jerk decisions in our portfolios here. Sure, are we happy with some of our sectors that have been performing well? Absolutely. But it's by no means us making a specific trade towards a theoretical Trump policy right now. So, what could happen between now and January? I think you could see a little bit more silliness in certain sectors. A good one, as an example, clean energy or clean. Yeah, we'll go with clean energy, like solar, wind. After the election, those stocks got hit extremely hard. Oil and gas companies have done extremely well. So I think you could see more of that silliness as you go down the line and say, if this policy is enacted, who would benefit? So I think that's going to happen between now and January 20th.
Yeah.
But then post January 20th, I would say there's going to be more silliness, but there's going to be more of an emphasis on, okay, how will these policies truly affect these companies, and do we need to correct the silliness that we had? So what I'm trying to say is there's going to be volatility between now and when we actually get the reality of policies.
Sure.
If we want to take a step back from just trying to pick which stocks work best and which stocks don't, I think from a general market perspective, I think the market finishes this year higher than we are today. But then if we look into 2025, 2026, I would say that we need to moderate our return expectations, to be honest with you. Over the last, I think the 15-year average for the market is like 13% right now.
It's crazy.
I would go on a limb and say I would expect a 6 to 8% return for the next, 4 or 5 years would be my guess. My educated guess. And the reason for that is primarily how expensive stocks are. If we look at what we call the valuation and a traditional one that people look at is the price to earnings ratio, the 10-year average is 18 times or to 18x price to earnings. Right now we're sitting at about 22x. So, the valuation
pretty expensive. Yeah, everything's pretty overpriced.
And it's not necessarily a predictor in saying that the market needs to crash, but what it's really telling us is the market needs to catch up with the valuation.
Sure.
So instead of, seeing the 13% years, we're probably going to see more of the 6 to 8 with some added volatility in there.
Yeah. I mean, I kind of relate that like we talk about inflation. Inflation went from, if bread went from $1 to $1.50, but now it's going from $1.50 to $1.75. We didn't say inflation isn't there. It's just slowing the growth. And same thing with the market, I think is what you just said. If we're over the last 8 to 10 years, we're averaging 13%. We're not saying the market's going to crash or not grow, but it needs to slow its growth rate. Now its growth rate, as you said, maybe from an educated guess standpoint would be more in a 6 to an 8%. So that doesn't say no growth or crash. That just says more a slower, more sustainable growth rate.
Yep, exactly. So
makes sense.
Obviously we'll try to position the holdings in our portfolios the best we can for the most opportunistic thing.
Sure.
But I think from a general market perspective, I do think we just need to moderate. We shouldn't be expecting this 13% going forward. I just think it's too much. And we saw post-COVID, companies were able to expand their profit margins quite considerably to the highest level that we've seen in decades. So the rate at these companies being able to do that, like you said, it just needs to slow. We need to recalibrate. We need the valuation to catch up with everything that's happened in the last 3 years, because we've, outside of 2022, I think the last 5 years we've had like a 20%, 25%, 30%. Right now we're sitting at about 30% this year, right? It's like we've had some pretty stellar,
crazy
record highs after record highs. I mean, it just
Yeah.
keeps hitting record highs, the markets and the S&P, and yeah.
So we just need to take a breather and just
Yeah.
moderate what we can expect going forward.
Well, hey, we have to take another quick break here to give away some copies of Jason's book. Did you know Jason has a book, Tyler? It's called Empower Your Retirement, and it's a great book. It's fantastic. So listeners, the next 10 people to call Jason's office will get a copy of the book, and that number is 989-835-7203. Again, that number is 989-835-7203. And if you have questions for Jason or want Jason to ask Tyler some specific questions about their situation and their investments, all you have to do is call and set up a no-charge, no obligation consultation with Jason and his team at Great Lakes Investments. The number again, 989-835-7203. All right, we're here with your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with our host, Jason Cryderman, the man with the plan. And today, on our 100th episode, we have an amazing guest. That is Tyler Ellegard, portfolio manager for Gradient Investments, a very fast-growing investment firm, been around a while now, doing such a great job there for folks and for the back end, helping Jason take care of his clients. Jason, this has been a great discussion so far.
Yeah, it is. It's not only is it our 100th show, which again, thank you, Tony. I mean, this has just been amazing. That can't believe it. We've already had recorded 100 of these shows, and hopefully here we are. Cheers to 100 more to come. And to have a guest on my 100th show, to have a guest like Tyler, who's probably the number one portfolio manager for Gradient Investments, who's over a $6 billion wealth manager in the United States. It's amazing. It's awesome. So what a way to celebrate. Our listeners and our viewers get a heck of a celebration today. And yeah, we've talked about some awesome things so far from Tyler, from Federal Reserve to President, the election being over, to what could happen between now and the end of the year. And I want to just kind of follow up with a couple of I love analogies, right? And so I think something that Tyler said in the last episode was, we got to be careful. We get excited about what we hear. Like, I'll call it propaganda over policies, right? So propaganda, drill, baby, drill. Well, that's what's on the front of a t-shirt, right? Be careful how you invest your portfolio by what you see on the front of a t-shirt. As much as it sounds okay, great, but what will come of the policies once the Trump administration takes office, once they get things signed into effect? What does that look like, and what are the results, the actual policies over the drill, baby, drill propaganda? So I think that's really important to point out. Don't get too excited. Be positioned to be ready, but don't get too excited and go all in on the propaganda of drill, baby, drill. Another one, I think, you mentioned between now and the end of the year, maybe more silliness. I love that you said that. And I think we ended the last segment with talking about sustainability. Can the market sustain these 13, 14, 15? No, the market can't do that. That's really not, overall, it's not healthy. So we need to be careful of this. Don't get caught up in the silliness and wait for the sustainability. Mm-hmm. What can the market sustain? And a lot of that is going to be, what are the results of the policies that are put into play that should dictate and determine the sustainability of the markets moving forward. And so it's important to be ready and prepared for all things, good and bad, coming into this next 4-year, what we have, this new presidential cycle. But be careful, be aware, be educated. And that's where I rely on Tyler and his team at Grady Investments to help me be educated and aware so I can pass that on to my families and my investors through the show, through my podcast, through my YouTube channel, through all my personal meetings with my investors. So again, Tyler, thank you very much for kind of taking all this stuff from behind the scenes and breaking it down into the reality and what, the commonality, what we should just move forward on a day-to-day basis, understanding from where we are today and where we could be moving forward. So let's kind of go a little bit further. Let's talk about earnings season. We got a little bit of time left here in the show. Let's talk some about earnings seasons and the reports that we're seeing versus anticipated and what we can think about moving forward with these corporations.
Yeah. So I would say about 85% of the S&P at this point, or I'd actually go with 90% at this point, have reported their earnings. And generally speaking, they've been good, but on a normalized basis, what typically happens as we head into earnings season is there's expectations, which is a aggregation of Wall Street analysts' estimates, basically.
Sure.
And what starts happening about 3 weeks before earnings season actually starts, companies start talking to the analysts, or the analysts start reaching out to the investor relations teams at the companies and trying to figure out how they're doing versus the expectations that's out there. And the management team, of course, wants to underestimate and overdeliver, right? So typically what happens is they start walking back some of the estimates, saying, this is happening in the environment. And they don't say specifically about the company, but they just start talking to the analysts about, from a macroeconomic perspective,
Sure, yeah.
This might not be going our way, or this or that. And so the estimates start to creep down a little bit going into the quarter. And then all of a sudden the company comes out and beats the expectation, but came in probably
by design, right?
Yeah, if you compared it to what the estimate was 4 weeks prior, is probably right in line with that, right?
Mhm.
So typically on average, about 75% of the S&P 500 companies beat expectations, right? That tells you all you need to know.
Right. Mhm.
So, what we typically look at is what are the actual magnitude of the earnings beats and what was happening prior to the quarter. Were the estimates coming down or were they not? That's kind of what we look at as we assess the companies in our portfolios.
Sure.
But I would say, generally speaking, earnings were good. Commentary from the management teams were, I wouldn't say great, but from everything that you hear on TV or you read about, this negative economic indicator came out and things don't look the best. I would say, generally speaking, companies were not great, but good or fine. So what that tells us is things will be okay going forward. The companies aren't necessarily seeing big stretches in consumer wallets just yet, even though we're hearing about it from the media and you could read different reports. But
Mhm.
I would say companies are actually feeling pretty good going into the holiday season, which typically is the big blockbuster spending event, right?
The Santa Claus rally, right?
Yes,
Yep.
exactly. So
Yeah.
what will start happening early next year, is we'll start to get commentary from the management teams about, the full 2025 expectations. And I think that's really what the market is going to pay attention to. But in the short term, I would say earnings season was good. The only caveat I have with earnings season is that we have our biggest company yet to report, which is Nvidia, and arguably the most important company for the S&P 500, because it's the chips that allow us to have AI, and it's what all of the investment around AI is getting, are the Nvidia chips. So Nvidia is coming up this Wednesday. We'll see how it goes. We just got news out today that customers are a little bit concerned about Nvidia's new Blackwell chip with some overheating concerns. So we'll see how the actual report goes and what the company says about going forward. And I think the reason it's such a important component for the market is if you look at the other biggest companies within the S&P 500, you've got Microsoft, you've got Apple, you've got Google, you have Meta or Facebook. And what are those companies doing? Well, they're building large language models. I should throw Amazon in there too. But they're building these AI models, large language models, to have some type of AI tool for you to use when you're using their products. And so they've been spending, I think this year, the projected spend between those companies alone on AI specific capital expenditures is over $100 billion. So
that's real money.
That's real money.
Even to you, Jason.
Even to me, that's just real. That's real money, Tony. You're right.
And so if, depending on what this Nvidia company says, maybe that starts to slow a little bit. Maybe if the company, they've already been having some issues with their new chip that they've been producing. So maybe if that continues, that could be a bad thing for the market. So it'll be interesting to see. But Nvidia has been a phenomenal company to own. But at some point, what we're really concerned about with Nvidia is at some point there needs to be a return of investment for these companies, right? When you're spending $100 billion every single quarter, year on this type of product, and you're not seeing any revenue generated from it, at some point you need to wind it down, or you need to be producing that revenue. So that's what I would actually say, in our opinion, the capital spend of the other companies during their quarters is probably more important, because that gives you an indication of what is going to happen with Nvidia. So what we did was look back. It seems like Nvidia should be okay, which means the market, will be fine for until the end of the year, until their next report. But yeah, I think the earnings season has been good. Not great, not bad, good or fair. And then we'll have to wait and see until Wednesday afternoon to see what Nvidia has to say for us. So
good. Can't wait to hear more on that.
Yeah, for sure. Well, hey, guys, we're out of time for today's show, but it was a good one, a fantastic show today. Before we go, is there anything else you wanted to add, Jason?
I want to say again, thank you to all my listeners out there. Thank you to my viewers. I can't believe it's been over 5 years now for a radio show altogether. Tony, thank you to you and the team at the Gradient Radio team. It's been 100 shows as of our recording today.
Yeah.
And Tyler, you and your team at Gradient Investments, thank you for being such an integral part of my business, my family, and being on my special guest on my 100th show today. So, guys, thanks a lot. Have an awesome rest of your day.
All right. Yep. And before we go, I'm going to add, if you want a copy of Jason's book, Empower Your Retirement, or you want to set up a no-charge, no-obligation consultation, pick up the phone, give Jason and his team at Great Lakes a call, 989-835-7203. And that does it for today's episode of your Financial Empower Hour.